All right, today we're going to be talking about FHA loans with Jerry. Jerry?
FHA is one of the most popular programs. FHA stands for Federal Housing Administration, which is the Department of HUD. Great program to get people into a home, very low down payment requirement, and very minimal FICO scores. Great, fantastic program. It's the most attractive down payment system that's available other than the VA, which is a zero down payment system.
And VA is strictly for military.
It's strictly for military.
Okay.
So the whole thing about the FHA program was that for 3.5% down, if you have a 580 FICO score, the FHA will give you a loan. It is notwithstanding a zero down payment, 3.5% is a very appealing number for most people who want to buy their home.
Now, you said 585 FICO.
Yes.
So it'll go down as low as 585 FICO. Obviously, the lower the credit score, the little bit higher the interest rate.
Yes.
We're going to hit that for you, right? But if you have a 720 FICO score, you can still go FHA down. The benefit of the FHA down is if you're stepping into the housing market for the first time, or let's say you had a life change and now you're back out on your own again. If you do have a good credit score, or maybe even not so perfect, you can get into a property with relatively some very small amount down.
Well, let's talk about what you just said. The FICO score is really going to be a rate determinant and not so much a down payment determinant.
Right.
So if you say, okay, I may have a 725 FICO score, but I still only have a small amount of money to put as a down payment, that FHA loan has got your name on it. And that's a great thing. Now, let's just say I've got more than 3.5% to put down. Well, that's wonderful. That just reduces the borrowed money, which reduces your monthly principal payment. Well, so that's a good thing. So there are two issues here. What amount of money can you afford to put as a down payment? And secondly, your credit score will be the rate determinant factor.
Right. Now, the only thing you do have for FHA loan, because you are putting a small amount down, is you have MIP, which is?
Yeah, the mortgage insurance premium. And the mortgage insurance premium is a necessary factor because it protects the lender from a default from the borrower. All right.
And they actually do that, just so you know, they actually do that because when you're only putting 3.5% down, there's not much skin in the game, and they've realized that if you do fall on hard times, you might walk away from it, and they don't want you to walk away from it. So if you have 10% down, there's a good chance if you have a $500,000 loan with $50,000 into it, not too many people are going to walk away for $50,000.
And let's take a look at the alternative if you go to a conventional loan. If a conventional loan, Rich, as you know, requires you put down 20% as a down payment. And secondly, they require a FICO score minimum of 620. So let's go back to your example of the mortgage insurance premium. So the mortgage insurance premium has two components. One is an upfront one-time fee of 1.75%. That's a one-time fee. The second component of mortgage insurance is a monthly charge, and that is about 0.8%. That is for the entire duration of the loan. Well, for most people, if you do the math, let's call it 1% just to make the math easy. So if you borrow $300,000, that means your annual fee is roughly $3,000. Divide that by 12, and that's added to your monthly payments. The reason we do this again is because the federal government wants to make money available to all the borrowers so they can buy a mortgage, buy a home. And the way they can do that is insist upon mortgage insurance. That money goes directly to the federal government, does not go to anybody else other than the Federal Housing Administration.
Right. So, bottom line, good credit, a little bit shaky credit. FHA is a really good way to go for an entry-level loan. Obviously, if you're selling a house and you have a lot of equity, you're going to be parlaying up into something else, it's not the loan for you. But if you're definitely a first-time home buyer or even a second-time home buyer or a third-time who maybe went through a divorce and now you're back out on your own, or some type of family situation where you're buying again, then by all means you need to look at an FHA loan, and we can definitely help you out with that.
And don't forget the other thing with an FHA loan, the FHA allows you to get a gift to help you with the down payment. So if you're required to have $10,000 as your 3.5% down payment, but you only have $5,000, but you have a relative, an aunt, an uncle that has $5,000 they'd like to help you with, they are allowed to gift you that $5,000 so that you'll have your down payment.
So yeah, so I actually like the gift idea thing. That's one thing I forgot, but that definitely helps a lot of people out. I've been in a lot of situations working with buyers, and they've had parents who have, young couples got married, and the parents will gift them $5,000 or $10,000 as a wedding gift to help them buy their home. So it works out good.
It's a great concept. The FHA program is a great concept, and it's well thought out. And what the FHA wants is people to be able to get a mortgage so they can buy a home. The American dream is to own a home.
And the only, I guess the last thing I want to say when it came to the mortgage insurance premium, even though you said it was pretty much in perpetuity with the loan, once you get to the point where you have enough equity in the property, you can refinance out of your FHA
Absolutely.
loan. You can refinance out of that and the mortgage insurance goes away. So that's touching on FHA loans. If you do have any questions about these loan products or any others, please feel free to reach out to myself or Jerry, krcrealty.com. Rich Farmer with KRC Realty and Property Management. Love to help you guys out.